Hi there. In this video on sources of business finance, we're going to take a few minutes to look at venture capital. So what is venture capital? Well, venture capital is an external source of finance, and it typically involves the financier, the venture capitalist, investing in the share capital of the business. Not exclusively. Venture capitalists often also provide loans as part of their financing, but here we'll just focus on the venture capitalists providing equity or share capital finance. And they do so on behalf of venture capital funds. It's otherwise known as private equity funds. And these funds are drawn together from a variety of big investors, for example, pension funds, insurance companies. They provide the fund and give it to professional investors to go looking for appropriate investment opportunities. So therefore, venture capitalists or private equity providers invest in a wide variety of businesses. We're not just talking here about small or startup businesses. In fact, most venture capital investment, I believe, is actually invested in established and large businesses, often where there's a need for the business to change ownership. For example, if the business founder is retiring. These are investments in share capital, and as I say, they're made by professional, qualified and sophisticated investors. And often the venture capital is provided to the business as part of a transaction, for example, selling a big stake or maybe financing a takeover. Well, venture capital, if you can get it, has a number of advantages for a business. Perhaps the most important being the sheer value, the significant finance that can be raised from these venture capital funds. And we're talking here not just tens, hundreds of thousands of pounds. Of course, that's possible from smaller venture capital funds in particular, but we're talking millions, hundreds of millions, indeed, sometimes billions of pounds worth of finance provided by the venture capitalist. And another advantage of this is that can therefore allow the business to access finance for some significant transactions, as say, for example, a change in ownership, or perhaps to support a significant takeover. Venture capitalists tend to specialize. They have their investment criteria where they're looking to invest in particular types of business or particular segments or sectors or industries, and they build that expertise in those industries and markets in order to identify attractive investment opportunities. Another advantage of having a venture capitalist on board, if you can achieve it, and it's not easy, is that you then get access to significant and very sophisticated business support as part of their investment. Well, the downsides are potentially quite significant depending on what you want finance for, because with most venture capitalists, we're talking about the sale of either a significant minority or even a controlling stake in the business. So you lose control. It's often said that venture capitalists effectively own the business once they have invested in it. It can be a very expensive and time-consuming process because you're dealing with sophisticated specialist investors. They'll want to undergo a thorough review of your business plan, do what's known as due diligence, which, if you like, is a detailed check of the business to see what the issues are, what the opportunities are, to check all the legalities of the business. And it's a time-consuming and quite complex process. But if successful, you can raise significant finance. I've mentioned also that venture capital isn't just share capital finance. A venture capitalist will often, as part of the transaction, also put some loan capital into the business. Sometimes it's convertible into shares, depending on how the business performs. And of course, don't forget with venture capital investment, as for example, with a business angel investor, basically the venture capitalist is thinking about the return it wants to earn from investment, and the return typically arises when the business gets sold. So normally a venture capitalist will be concerned about what the business might be worth in 3, 4, 5 years' time when they make their investment. There we go. Hopefully that's useful. Just a brief overview of this type of external finance in a business known as venture capital.